Gold's trading range keeps narrowing, but a breakout remains elusive. Is sticking with the buy low, sell high strategy still the smartest move? And could the closely watched US-China trade talks be the catalyst that finally sets gold in motion? All that and more in this week's As Good as Gold. Greetings, fellow traders. I'm Dylan at Research Strategies at Pepperstone, presenting the latest weekly update on As Good as Gold. So over the past week, gold has remained in a tight consolidation at elevated levels, with the trading range continuing to narrow. On one hand, optimism around US-China trade talks and signs of a resilience in the US economy have kept gold under pressure. But on the other, ongoing geopolitical tensions and strong central bank buying, led by the PBOC, have provided a firm floor. While heading into this week, any meaningful breakthrough in tariff negotiations or surprises in the US core CPI could provide pivotal in steering gold's next move. And now if we take a look at the 4-hour chart of gold against US dollar, prices have been broadly range-bound between $32.80 and $33.80. The 3-day rate of change is barely moving, and bullish attempts have repeatedly failed to break above the 50-period moving average. If that level gives way, then $33.80 could act as key resistance, but if gold pulls back towards $32.80, we might see dip buyers return. Well, the main issue at the moment is that gold's momentum just hasn't picked up, and that's largely because the market is caught between two opposing forces. The first is the ongoing dialogue between the US and China. Although no concrete deal has been struck, market participants increasingly believe that the US still relies heavily on China's for rare earth. That makes some sort of compromise, perhaps in exchange for greater freedom to export semiconductors, more likely. There's also an underlying expectation that the tariff deadline might be pushed back. This kind of ongoing engagement, along with broadly constructive sentiment, has significantly reduced the need for safe haven hedges, and that's taken the shine off gold for now. While at the same time, US data are holding up well. While recent ISM manufacturing and services data came in weaker than expected, the latest non-farm payrolls report show a solid 139,000 jobs added in May, beating forecasts, with the unemployment rate holding steady at 4.2%. On top of that, softer indicators like consumer confidence from both the Conference Board and the University of Michigan have started to show signs of stabilizing. So even though Trump has been calling for a full 100 basis point rate cut by the end of the year, the market still only priced in 2 cuts, which is hardly a bullish setup for a non-yielding asset like gold. That said, the fact that gold hasn't broken down despite this kind of headwinds tells us something. In my view, there are still 2 major forces helping gold find a bottom. One is geopolitics. Trump's move to deploy the National Guard in Los Angeles protest, alongside efforts to push through the Big Beautiful Bill focused on military and border security, has only added fuel to existing tensions. Meanwhile, the war in Ukraine is showing no signs of easing, so that kind of geopolitical backdrop continues to support safe haven demand. While the second factor is central bank buying, if we zoom out a bit to the bigger picture, what's really providing a long-term floor for gold is the strong and persistent demand from central banks. Ever since the US and its allies froze Russia's foreign reserves in 2022, central banks around the world have doubled down on gold purchases. Concerns about inflation, as well as fears that the US might eventually weaponize its debt against foreign creditors, have only made gold more attractive. And with the PBOC adding to its gold reserves for a 7th straight month in May, the push for de-dollarization continues to lend strong underlying support to gold. So all in all, gold is stuck in a tight range between $32.80 and $33.80. The softer risk-off sentiment, progress in trade talks, and steady US data have taken some steam out of gold's rally, but ongoing geopolitical tensions and central bank accumulation are keeping prices from falling. And even though the range keeps tightening and the market is hungry for a breakout, I think for now, range trading, or buying low and selling high, still looks like the most practical approach, at least, especially with no clear directional trigger just yet. And looking ahead, the next key drivers could be progress in tariff discussions and the US core CPI data for May. The market's expecting a month-on-month uptick to 0.3%, while the annual rate holding at 2.8%. If inflation surprises to the upside, that could delay the Fed's timeline for rate cuts and weigh on gold. But if the data comes in softer, perhaps due to lower energy prices, we could see a modest lift to gold. So that's pretty much all for this week. If this video is helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!